Welcome to the Retire Ready Podcast, the podcast that helps Canadians prepare for all that retirement brings. I'm your host, Scott Sather, founder, president, and financial planner at Awaken Wealth Management, and portfolio manager with Awaken Investments of Aligned Capital Partners in Regina, Saskatchewan. Thanks for joining me today. Now, the big question many Canadian retirement investors have is, should you invest through the RRSP or the TFSA? Both have their pros and cons, so we're going to explore those today and talk about which option is the best for which situation. So before I jump in though, if you want to get the details on these two different registered accounts in Canada, then you should go to listen to the last two episodes of the podcast where I go in depth on the ins and outs of the RSP and the TFSA. For today, we're assuming you've already listened to those episodes and you know the basics on the accounts. All right, let's get started. The question of whether you should invest in the RRSP or the TFSA is easily answered with, it depends, as it really depends on why you're investing and what your individual situation looks like. Using both accounts likely makes a lot of sense, but different situations mean using different accounts. For example, if you're saving for something short-term like a holiday or emergency fund or even a bigger purchase like a vehicle, the TFSA is likely the best option as it will allow you to invest tax-free, meaning no tax consequences at withdrawal. You'll receive your contribution room back the following year after your withdrawal, and allowing you to continue to use the account for saving for another goal. If you're looking at buying your first house, then definitely look at the First Home Savings Account as it's the best option. This account allows you to save tax-free as your contribution is tax deductible. The growth inside is tax-free as long as it's used for a house purchase. And if it isn't, you're able to transfer the funds to your RRSP without any RRSP contribution room. But we're talking RRSP versus TFSA, so let's get back to that. After the FHSA, the next best place to save for a first-time homeowner is likely using the RRSP and a home buyer's plan withdrawal. After that, the TFSA then makes sense to save for that down payment. You can find more info on the FHSA in the show notes if you visit retirereadypodcast.com and visit the episode 9 page. If you're already in a house and looking to upgrade by saving a bit more for that down payment, then the TFSA would probably be the better option, as the First Home Savings Account and Home Buyer's Plan would likely no longer be available to you, and if you're withdrawing otherwise from that Home Buyer's Plan, any withdrawals are taxable to you from the RRSP. If you're looking to go back to school, to upgrade your education, then the RRSP can be a great option using the Lifelong Learning Plan, followed again by saving through the TFSA. Again, more info on these strategies will be available in the show notes. Since this is a retirement-focused podcast, we should discuss which of these accounts are the better options for your retirement savings. While the RSP actually has retirement savings right in the name, it might not always be the best option for everyone. That's where looking at your own individual situation will define the best option for you. Generally speaking, the TFSA is likely the better option if your income is below $50,000, and the RRSP is the better option once your income is over $50,000. That's due to the tax deductibility of the RRSP contribution from your taxable income and the corresponding tax rate you will pay. At the core of these two accounts, with all things being equal, that is rate of return and tax rate before and after retirement, these two accounts will actually end up with the same amount of money. However, when are all things ever equal? That's why we're going to discuss some general recommendations when it comes to deciding between these two accounts. Also, the two are not mutually exclusive of each other, as I mentioned before, meaning that you can only choose one or the other. In fact, you can and likely will need to use both to reach your retirement goals. As well, I should mention the investment side of these two accounts, again stressing as I did in the last two episodes, these are just accounts, not investments. You hold investments within these accounts and both have the same investment options available to you. High interest savings accounts, guaranteed investment certificates or GICs, term deposits, stocks, bonds, mutual funds, exchange traded funds, or ETFs. They're all available to invest in these accounts. There is one difference, though, when it comes to those holding U.S. investments and those who are U.S. citizens. If you're heavily invested in U.S. stocks, an RRSP can be advantageous since the IRS doesn't recognize TFSAs as registered retirement accounts, leading to withholding taxes on U.S. income. RRSPs are recognized and avoid this issue. As well, since the U.S. doesn't recognize the TFSA, those who have to complete a U.S. tax return lose that tax-free growth on the account. Now, coming back to that all things equal statement I made, very rarely are all things equal in these situations. For most retirement investors, we usually see them needing less in retirement than they do before. This results in an advantage for the RRSP. In the case where your income in retirement will be higher than before, then the TFSA definitely has an advantage. But let's just go through the pros and cons of these accounts. The biggest advantage of the RRSP is that the contribution is tax deductible, meaning if you make $100,000 and you contribute $10,000, your taxable income is reduced by the contribution, resulting in only $90,000 of taxable income, and you'll likely receive a tax refund come tax time. In comparison, the TFSA is invested with after-tax dollars. So in that same example, making $100,000 and investing $10,000 in the TFSA still results in you paying taxes on the full $100,000. The TFSA allows your dollars to grow tax-free, hence the name tax-free savings account, meaning you can withdraw those funds tax-free. In comparison, the RRSP grows tax-deferred, meaning that as long as it stays inside that RRSP account, you don't pay any taxes. But upon withdrawal, it is taxed at your marginal tax rate. What's a marginal tax rate, you're asking? Well, that's the rate of tax that the next dollar of income you earn is taxed at. So in the case of earning $100,000 in Saskatchewan, your marginal tax rate is 33% right now. Meaning if you make one more dollar of income, you'll pay 33 cents of tax on that dollar. Depending on the size of the withdrawal, it may push you up to that next tax bracket. Again, in the example we've been talking about, that next bracket starts at $111,734 in 2024. So let's say you withdrew $15,000 from your RSP on that $100,000 of income. The amount over $111,733 is now taxed in the next federal bracket, which is 38.5%, 5.5% higher than the amounts below $11,734. So $11,733 would be taxed at 33%, and the remaining $3,267 of that $15,000 withdrawal would be taxed at 38.5%. Now take that same example of making $100,000 and withdrawing $15,000 from your TFSA. There's no tax consequences as the TFSA withdrawal is tax-free. That's a huge difference. Oh, and adding to all of that, CRA has your RRSP provider hold back income taxes on your withdrawal to make sure they get their tax money. So if you withdraw between $0 to $5,000, they withhold 10%. $5,001 to $15,000, it's 20%, and everything over $15,000 has a 30% withheld. So in an apples-to-apples comparison, if you need $15,000 in your pocket, you could withdraw just that exact amount from your TFSA, but you would actually need to withdraw a total of $21,428.57 to net you the $15,000 after they withhold the 30%, or $6,428.57 for those doing the math. Now, the actual amount of tax you will owe on the withdrawal will be calculated come the next April when you do your taxes. So you might get a little bit back, you might owe a little bit more. From a contribution standpoint, the RRSP likely has more ability for you to contribute to the account. The TFSA is limited to a set amount per year for everyone to contribute. It's set by the government and indexed to inflation for everyone over the age of 18. So for 2024, the TFSA contribution limit is $7,000, again, regardless of your income. The RRSP, on the other hand, is based on your earned income up to the annual maximum, which for 2024 is $31,560. That means you would need an income of over $175,333 to reach that maximum amount. That amount that exceeds your pension adjustment, that is the value of the benefits you earned in the previous year under your employer's registered pension plan, RPP, and deferred profit sharing plans, also called DPSPs, and possibly some unregistered retirement plans or arrangements. That limit can then be increased by pension adjustment reversals and decreased by your net past service pension adjustment. All of these numbers will show on your tax assessment or in your CRA account, which is the best way to find out both your RRSP and your TFSA contribution limits, while also making sure to keep track so you're not over-contributing. That leads to another advantage of the RRSP. You have a lifetime over contribution limit of $2,000 for the RRSP versus $0 for the TFSA. So be careful to track those contribution limits. Oh, back to the contribution advantage. That likely will go to the RSP if your income is above $38,888.89, as that amount of income is what you would get for your RSP contribution room to be $7,000, which is the same amount as the TFSA this year. Both accounts let your contribution room accumulate, so if you don't contribute, you won't lose it and you can use it down the road. Speaking of withdrawals and contributions, the TFSA allows you to recontribute amounts withdrawn the next calendar year, whereas you lose the contribution room for any RSP withdrawals. So if in 2023 you withdrew $10,000 from your TFSA, come January 2024, you are able to recontribute that $10,000 on top of the annual increase of $7,000 to your contribution room. So for a total of $17,000 of contribution room for 2024. Those funds withdrawn from the RSP in 2023 are unable to be recontributed unless you use them for a first-time house purchase through the home buyer's plan or for furthering your education and using the lifelong learning plan. For those who are married or common law, there is the ability for the higher income spouse to use their contribution room and contribute to the lower income spouse's spousal RSP, which can allow for more efficient income splitting in retirement, especially for those who retire before age 65. Either spouse can contribute to their spouse's TFSA as well, but this is more of an advantage in comparing the TFSA to investing in, say, a non-registered account, where there can be attribution rules that apply to the income earned. So that's the lowdown of the advantages and disadvantages of both accounts. The major advantage of the RSP being the ability to deduct contributions from your income, resulting in tax savings now, and the TFSA having the advantage of withdrawing the funds tax-free and recontributing that amount withdrawn. But I mentioned before that the RSP has an advantage for those retirement investors with incomes over $50,000. And honestly, there can be some advantages as well for those below, again, depending on where you see income going in the future and into retirement. So let's talk a little bit further about that advantage. Again, when we contribute to the RSP, we get our income reduced by the amount of that contribution. But we invest in the TFSA, we're investing with after-tax dollars, meaning we've already paid the taxes on the money. So let's give a couple of examples for an investor in Saskatchewan who makes a gross income of either $50,000, $100,000, and $200,000 annually, and they contribute 10% of their income to the two different accounts. So, in the case of a $50,000 income, investor would pay around $8,453 in taxes, netting them in their pocket $41,547, which they then could take $5,000 and invest in the TFSA. If they instead invested that 10% or the $5,000 into the RSP, they would only pay $7,178 in taxes, and as the contribution lowers their taxable income to $45,000. So they have $5,000 in the RSP and save $1,275 in income tax, which they could then use to invest more into the RSP the following year, invest it into the TFSA, or use it to pay down debt. Some people find this newfound money and book a trip to Mexico or something else. My recommendation would definitely be the top three options, as it gives the RSP contribution just that much more savings power. For the investor making $100,000, they would pay $24,589 in income tax, leaving them around $75,411 to invest to make that $10,000 TFSA contribution. If again made to the RSP instead, the $10,000 contribution would result in a tax savings of $3,300. So they would only have to pay $21,289 in tax instead of the $24,589. And in the case of the $200,000 income, the investor would pay $64,357 in tax and then make their $20,000 contribution to TFSA, versus putting that contribution into the RSP that would result in only $55,594 of tax which is a tax savings of around $8,763, or 43% of the contribution. The tax savings on each of those contributions depends on the investor's marginal tax rate and the tax bracket they're in. That's why the larger income investor gets more of a tax break. They're paying a lot more in tax at that level of income, 43%. The $50,000 income is at 25.5%, and the $100,000 income is at 33%. So now, assuming these investors take that tax refund and invest it back into the RSP, they would get more of a deduction the next year. Or if they took the tax refund and invested into the TFSA, or even given the current high interest rates on debt, paying off a loan, a line of credit, or even their mortgage, will result in more savings and add to the RSP's advantage.
From an estate planning perspective, both accounts can name a beneficiary, so you can save the probate fees, but the TFSA has an advantage as the funds are tax-free to your beneficiaries, whereas the RRSP is fully taxable to you upon your death, unless you've named your spouse, dependent child, or grandchild under 18, or a financially dependent, mentally or physically infirm child or grandchild of any age. This is where some further planning should be done to help ensure things pass along the way you wish. So, talk to your financial planner and lawyer to get that estate plan in place.
The last advantage the TFSA has over the RRSP is that there is not an expiry date. That means you can continue to contribute to the TFSA as long as you're a Canadian resident. The ability to contribute to an RRSP ends at the end of the year you turn 71, where you have to either withdraw the funds from the account, paying taxes on the full amount, usually not the best option, convert the account to a registered retirement income fund, where you have to start taking a minimum payment out based on your age and the value of the account on December 31st of the prior year, or take the funds in the RRSP and purchase an annuity. After age 71, the only way to contribute to an RSP is through your spouse's spousal RSP, assuming you have contribution room and that they are under 72. Many of the detractors to the RSP, those that are against it, are those that are now retired and drawing from the account. They've forgotten the tax benefits that they once received that allowed them to be in the spot they are now. Remember, paying taxes isn't a bad thing. I mean, it means you're making money. Paying too much in taxes, though, is never fun. And, well, that's a story we'll leave for another episode. Maybe. Having said all that, you can have too much of a good thing, meaning you can have too much in your RRSP. For most, that won't be an issue, and it's hard to quantify exactly what that magic number is, but I have seen it. It's those rare cases where the income in retirement is much higher than before, which results in more taxes, possible loss of some of the government benefits. Not that we should be investing to ensure we qualify for those benefits, but if we can, and if it fits your needed income to meet your goals, then we can definitely want to try and do that. And it can also result in more going to taxes upon your death and less going to your beneficiaries and charities. With all of that being said, I would highly recommend you discuss with your financial planner which of these accounts makes the most sense for you and your situation. Okay, I think that covers everything for this time around. Once again, be sure to click that follow or subscribe button. Please email me at info@retirereadypodcast.com with any questions you may have. You can view the resources and links I talked about in this episode and find the show notes by visiting retirereadypodcast.com and going to the episode 9 page. You can also subscribe to the Wake Up semi-monthly newsletter by visiting the Awaken Wealth site, which is awakenwealth.ca. Thanks again for joining me today, and I look forward to seeing you back for the next episode.
Thank you for listening to the Retire Ready podcast. To subscribe to this podcast or to learn more, please head on over to awakenwealth.ca/Retire Ready podcast. Investment services are provided through Awaken Investments of Align Capital Partners Incorporated, an approved trade name of Align Capital Partners Inc. /ACPI. Only investment-related products and services are offered through ACPI or Awaken Investments of ACPI and covered by the Canadian Investor Protection Fund. Tax planning, financial planning, and insurance services are provided through Awaken Wealth Management Limited. Awaken Wealth is an independent company separate and distinct from ACPI or Awaken Investments of ACPI. Awaken Wealth are not licensed tax professionals, and you should consult with your tax advisor before acting on any recommendations. Investments and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use your best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.